Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and I'm Mathew. This show gets you actionable insight on everything mutual fund related, whether it is deciding your overarching strategy or reviewing whether you're invested in the right schemes. On today's program, we'll start with a chat on Edelweiss Mutual Fund's newest offering, and that is their tech fund. We'll discuss how they're planning their portfolio strategy and what the objective is. We'll then delve deeper into investing in tech strategies overseas through mutual funds. There are regulatory restrictions in place, so which schemes should you look at? All of that and more today. But first, let me introduce you to my guest at the start. And we've got Trideep Bhattacharya, Chief Investment Officer of Edelweiss MF, joining in. Trideep, thanks so much for taking the time, and pleasure speaking with you as always. Your NFO starts today. Talk us through the idea behind it, and we'll delve a little deeper into the planned portfolio construction then.
Sure. First of all, thanks for having me in your very popular show. I would say that overall, one of our thesis or thinking right now is that the global growth actually will bottom out this year and will rebound next year. And as a play on rebound globally next year, this year could be a good year to accumulate thematic portfolios like technology, which is ultimately a play on global earnings. When we think about technology, we obviously think about technology in the Indian context in a broader way, which is Indian IT services companies and also the new age companies. And we also combine this with some of the global tech leaders to get access to those technologies like AI and a few others, which are mostly on the B2C domain and not available in India. So as a concoction, the fund that we are talking about in the form of Edelweiss Technology Fund gives investors an exposure to not only Indian IT services plus the newest technology companies, but also global industry leaders. And hopefully that is positive from an investor portfolio standpoint over time, both cyclically, given the global rebound that we think might happen next year, and also structurally, as technology penetration across different industries is growing rapidly and will likely grow even further going forward.
Now, when we get into the construction or the proposed construction of this portfolio, Trideep, as I understand it, it's going to be 70 to 80% Indian stocks and 20 to 30% foreign stocks, and within the S&P 500 universe. How is this going to work? How is this dynamic going to work?
I think basically the 70-30 mix is just about the right one. And the reason I say so is, keeping it, of course, within 30% or within 35% gets us the equity taxation. And hence, that is beneficial from investor standpoint. Secondly, I mean, overall, if you look at while Indian companies are mostly B2B dominated, our customers are mostly businesses. The US technologies, which is now US technology stocks, which are mostly seen as a proxy for the rest of the world tech, are mostly B2C dominated. So this combination of 70-30, call it, gives the investor a right mix of B2B and B2C, right mix of India as well as global, and just about serves right from the taxation perspective. So that's the best that we could package in one fund.
Now, if I look at the themes that would fall under tech, it's quite wide-ranging, all the way from generative AI to fabricators. I'm talking about semiconductors and chip designers as well. And all of those are themes, Trideep, that have run very well over the last several months. The question is, we're launching now, and we're looking at a fund that is looking to benefit from these developing themes. The question that some people will ask is that potential currently in the price? And are we buying at elevated valuations?
I think, good question. So I will say that overall, first of all, the economic situation in the United States or globally is not particularly great. We all know that. And hence, tech as a play on global earnings, particularly from a B2B standpoint, hasn't really done well. So if you look at, for instance, the Indian tech sector, right, it has underperformed the broader market by at least close to about 20% over the last couple of years. And that makes the starting valuations for Indian companies or tech companies overall in general, relative to their own 10-year average, reasonably attractive. That's number one. The second point I would say that overall, from a global standpoint, some of the trends that we are talking about, like you mentioned, artificial intelligence, robotics, Internet of Things, and likewise, these are actually decadal themes. They don't go away in 1 or 2 years, and hence I would suggest that these would they are more structural in nature than otherwise, and hence taking an exposure to these themes would actually benefit investors over a long period of time. And we are suggesting those investors to invest in this fund who have an outlook for about 5 to 10 years. So I would actually think this serves a very good purpose for investors who want to take exposure to Indian IT services, Indian technology names, which have lagged the broader market and have still decent valuation support. And at the same time, want exposure to some of the global technologies like artificial intelligence, robotics, IoT, which have a shelf life of at least more than 10 years and are more structural in nature.
Understood.
So I think we're just about at the right time, if you ask me.
No, and it's an important clarification to make, because I think a lot of people, Trideep, jump into tech or rather thematic funds in general, thinking that they can ride the wave of something that is playing out and make a quick buck. But then what you're saying is that this is a theme that you anticipate will play out over the long term, and so you should have a 5+ year time horizon. And it's important to make that clarification. I also want to understand, there are restrictions that are in place currently for the industry with regard to investing in overseas equities. How is that going to constrain you, if at all?
So at some size, probably, it probably does. So the starting point is, at the moment, with regards to our own overseas offerings, and likewise, we do have space within the industry prescription, which is within the limits of what we have already invested, given the redemptions that the other in some of the other places. So we have a bit of space within our existing limit to participate globally. And mind you, the global component is just about 20 to 30%. So from a overall fund standpoint, we can scale up meaningfully before even thinking about violating or hitting those constraints overall.
Understood.
So on net balance, we are not worried about that.
Understood. I'm just trying to understand how far you will go. Now, you've said US S&P 500, which is in fact quite a large universe just as it is. Are you restricting yourself at all to the very large players? And we're talking about something like an Apple, and I'm sure that some of my viewers are aware of this. You would look at the market capitalization and say, hey, you know what, the Indian stock market is comparable. So therefore, are you looking at the very large companies, or are you willing to go broader as well?
So I think it's a good question. And the first thing is what we are looking to do in taking exposure to US stocks is using US as a proxy for global technology. That's the first point that I would make. If you look at Indian technology companies, they operate at one subsegment of tech, which is or mostly operate in one segment of tech, which is IT services. The other areas like semiconductors, hardware, components, AI, and areas like these, which are more B2C in nature, are not available in India. And that's what we are looking to explore. That would be the second part that I would highlight. The third I would highlight is that when we are looking at S&P 500, it is mostly the universe that we are talking about, that the universe is S&P 500. Actually, within the S&P 500, we are looking at companies which fall under technology domain. And within that, we are probably going to limit ourselves to the top 50 names. So yes, we would be kind of looking at the larger cap names overall in the global scheme of things. But at the same time, those are the guys who are benefiting disproportionately from the emerging trends, because the big gets bigger, particularly in the context of technology. And I mean, one can only look at how Amazon has grown, or how some of the other global names have actually grown over a period of time. And these are just example, not stock recommendations. But net, the US component would be managed in a more rule-based manner, as you're showcasing. It will be rebalanced on a quarterly basis, but it will be the subcomponent of technology part of S&P 500. So it will include some large caps or some mega caps, some large caps, but certainly not global small caps or thereabouts. It will be the larger caps ones which will be exposed to.
Understood. Trideep, the last question, and that relates to the timing. We're speaking on a day when we've just had the CPI print in the US. It is not what people had anticipated, to say the very least, and you've seen a reaction across the board in risk assets. The question is, if we do have the rate cuts now pushed down the road, one would only assume that the landscape for at least the Indian IT services does not look too rosy for the next three to 4 months or thereabouts, at least half a year, right? Is that something that you're factoring in? Is that a risk that you need to bear in mind?
I won't say so. One of the golden rules in investing is invest when there is a famine outside, and take profits if there is a feast all across. So when global data points are contrary to the fundamentals, you get share prices which are available at valuations which are worth looking at. And I would agree with you that overall, in the very near term, i.e., 3 to 6 months, we don't think that the fundamentals will change dramatically in the positive direction. And hence, I said that overall, we think that this year, calendar year 24, is a year when investors should gradually accumulate exposure to this sector via our fund, because we think come CY25, the next calendar year, you would start seeing recovery coming through, and as a play on that, things would improve. So yes, delaying of rate rate cuts does sort of delay the immediate improvement, so to speak. But then that's when you get the best valuations to invest from a share price standpoint, which is the seed for future returns for investors over time.
I'm glad that you said that. Thanks so much, Trideep, for joining us and for having this conversation with us. Pleasure speaking with you.
Thank you very much.
And joining me now, we've got Shweta Jain of Investography, as well as Vishal Dhawan, who is the Chief Executive Officer of Plan Ahead Wealth Advisors. Thank you so much to the both of you for joining in and for agreeing to speak to me on this. We were speaking about tech funds, and we were speaking with Edelweiss MF CIO about their latest offering. So I want to start by asking you, Vishal, about what you make of tech funds in general. There are a few available right now, and one would think, and what his point was, is that it's a good time to accumulate now because the sector is not essentially, at least in India, firing on all cylinders. What do you make of it?
So there's clearly been this, cycle that tech has gone through. So there was this huge euphoria that came, during and post-COVID with the increased digitization that was happening across businesses. And then we saw that two events took place. One is probably a lot of pre-buying happened and sort of overcapacity got created. And second is we saw interest rates actually starting to move up fairly significantly globally, causing discretionary demand to actually come off. So what seems to have happened is there is a reversal now where you are actually starting to see interest rate cuts starting to get talked about maybe second half of 24. And you also are seeing that earnings could possibly, the degrowth that was happening is probably bottoming out. And therefore, it may be a good time for people to tactically accumulate the IT sector, as long as they clearly understand the risks of going to a single sector, because things can reverse very quickly. And if they're not adept and quick enough and nimble with some of those decisions, they could end up, getting the wrong end of the cycle.
Fair point. Shweta, anything to add here with regard to tech funds in general? And also, of course, the Edelweiss NFO?
Yeah, so I'm a little wary of thematic funds. I'm not a fan of thematic and sector-specific funds, especially for new investors. I think seasoned investors can limit their exposure to up to 10%. But for new investors, it's a definitely avoid. and a no from me, for the simple reason that their entire experience in the future could be driven by this and we could drive them away completely. So for new investors, I would say stick to your diversified funds, get to the boring returns and experience first, and then you can look for a little bit of a thrill a little later once you're experienced investing in equities.
Okay, fair point. I'll come back to you, Vishal, on this next one, which is that there are restrictions that have been in place for some time now that restrict mutual funds on how much they can buy in the overseas market. Could you explain that to us and how that's changed the functioning of schemes that are currently operating?
So, there is sort of a reasonable history now along this, sort of constraint that domestic money managers have had when they've tried to allocate money to invest internationally. There was a limit of about $7 billion available for funds, which once upon a time seemed like a very large limit. And then there was also $1 billion available for ETF purchases. And that limit unfortunately got breached, either because there were sort of specific international funds. So there were funds that were combinations of domestic and international stocks or ETFs, which also started to hit that limit. So there was a point in time where virtually all inflows into these got stopped until you had this big correction that happened through 2022. And therefore, in the middle of 2023, you actually had a point where, because of mark-to-market reductions that had happened, there was an additional window that got opened up to buy internationally. So clearly, those investors who are looking to buy internationally through a domestic mutual fund are still constrained because they don't have the entire suite of products available. There are some available, and even within those which are available, there could be nuances of some allowing lump sums, some allowing only SIPs, some allowing STPs as well, but not allowing it. So there is a fair amount of complexity when one wants to do this. In contrast, if one wanted to use the LRS route to invest internationally, besides things like TCS, etc., that they have to worry about, the suite of options available is much more.
Before I hand it over to Shweta to ask the same question, I want to ask you as well, what are the schemes that are currently available that are open for investors to put money in that also play that tech theme, since we're talking about funds that invest, domestic funds that invest overseas?
So broadly, there are three things that you can classify them into. One is those which are purely tech funds. So those funds are like, the Invesco QQQ fund. You have the Edelweiss, US tech fund. Those are pure sort of technology funds that allow you to get there. Then you have these funds which are sectoral tech, but could have international exposure as well. For example, if you go to Franklin India Tech Fund, it allows you to buy 80% local and 20% global. A lot like the Edelweiss one, which is doing a 70-30, for example. And then you have these very broad-based funds which could either be buying the indices internationally, like the S&P 500 from Motilal or the HDFC Developed World Index, or you could have the Franklin US opportunities type of funds or the Nippon US equity type of funds, which are active funds which have a lot of tech exposure, somewhere in the region of about 40%. So depending on how one wants to really buy this basket, one can choose and pick, what is the method that you want to run on this.
Shweta, you want to come in on this? In the tech fund space, I know the overarching view is that new investors should avoid, but if you are a nuanced investor, and I think even Trideep from Edelweiss has pointed out that you should have at least 5 years of a horizon if you're looking at investing in his fund. So therefore, which schemes do you like in this space?
So I like the Motilal S&P 500. That's a scheme that we've been recommending as well. So that's a scheme that one could look at from an international sort of tech space. From a broader category, of course, the PPFAS Flexi Cap is something that we've recommended for a long time now, and that's something that we like because it gives a good sort of combination for people who have been investing for a while and can get like a good combination of Indian and US sort of exposure. If you actually see the portfolio of PPFAS as well, you will see that it's while it's US equities, it's predominantly US tech. So I think that gives a good exposure and a good combination.
I'm glad that you brought up PPFAS because that's my last question of the day. And Vishal, I'm coming to you on this one. I have been looking at the portfolio construction of this particular scheme for quite a while. And we've spoken with the fund managers as well, and they've admitted that they've had to let the exposure of overseas stocks reduce quite dramatically over a period of time. It used to be 30% or thereabouts, and it's now, what, 15 odd percent or thereabouts, right? So does this dramatically change the way the scheme has operated, in your opinion? It has still managed to perform quite well.
Definitely has an impact because clearly the the historical sort of view that the fund has taken has that wherever they do not find opportunities to participate in a particular sector or a particular theme, or if there are global businesses that are more efficient to buy into rather than Indian businesses, they will try to allocate capital there. So they're clearly constrained by two things. One is just the fact that there is this cap overall. And second is, as a fund, they've had a lot of inflows coming in, both in the form of lump sums as well as SIPs. So there has been this sort of tapering down of international exposure automatically. And therefore, I think over a period of time, the benefits of the international exposure that they have will keep reducing, and therefore they will start to behave a lot like domestic funds unless those caps are changed. And therefore, what investors may want to do is, if they think that the structure of what PPFS had once upon a time is something that appeals to them, then they may want to look at other alternatives where domestic and international are combined together. It makes it a little more tax efficient. But more than that, I think if they're looking for this combination to come through, then they may want to look beyond PPFS, even though PPFS is an extremely good scheme.
Okay, fair point. And I would think that that holds true for certain other schemes also that have traditionally had high exposure and have had to change. Not many to speak of, because the size is what also matters, right? But both of you all, Shweta as well as Vishal, thank you so much for joining in and for breaking down this particular subject. Of course, tech is going to be in focus going down the road as well, and we will have to revisit it at some point. In the meanwhile, if you've got questions for us about this particular topic, or in fact anything else related to mutual funds, you can send them to us on the WhatsApp number. Of course, we've got a few questions as well, and we will take them up starting tomorrow. Do stay tuned, lots more coming up over the course of the day, and this is NDTV Profit.